Okay, good morning and happy Friday, everyone. My name is Tony Zhang. I'm the Chief Strategist here at OptionsPlay. Let's go ahead and get started and take a look at our Friday morning market outlook session. Before I do, just a quick disclaimer. What we're going to discuss here today is purely for educational and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. Now, today, what we're going to do is we're going to do a quick market update so that we cover the broad markets where we currently see. We had a big earnings event last night with Apple, Amazon, quite a few other big names reporting earnings, markets opening up a little higher. So we want to take a look at where markets currently sit in terms of broad-based indices, as well as some of the indicators that we typically take a look at to gain a directional view. And talk a little bit about this consolidation that we've been talking about for the past couple of weeks, and why at least the present moment, I still believe that this consolidation is going to continue. There does seem to be some indications that specific sectors, certain sub-industries, looking like they're about to break out or have broken out, and I want to point those out. But broadly, as a broad-based market, I still anticipate more consolidation ahead, and I want to show you why. And while we talk about markets continuing to have this bullish tone, potential breakouts in a lot of different sectors, I do want to take a step back and revisit this particular earnings season, what we're seeing so far. We did stress that this is an important earnings season from an information perspective, but also from a valuations perspective, because I do want to make sure that long-term investors, despite the fact that we feel markets shouldn't be trading this high from a fundamental perspective, from an economics perspective, how do we actually look at valuations? Where do they actually stand? And which valuation metrics are important? Then what we'll do is we'll take a look at the sector highlights, which sectors we see are lagging, which sectors are leading, and then finish up with some of the ideas. And at the end, if we have a few minutes, we'll try to answer your questions. Now, the primary question that we seem to be getting currently over the past couple of days is really, are markets about to break out higher, especially when you factor into yesterday's earnings report with Apple and Amazon both up 7% roughly pre-market. What does that mean for the overall market? Does that, between the consolidation we've seen over the past few weeks and in conjunction with this breakout we're seeing in some of these big tech names, is that going to push the markets higher? So those are the questions that we want to help answer. My name is Tony Zhang. I'm the Chief Strategist here at OptionsPlay. Let's go ahead and get started. So we'll start off with the S&P 500. So as we spoke about over the past few weeks, the 323 level is the major level that we're trying to get above. And recently, the market tried to push above that 323 level, but we talked about the negative divergence that we saw in that momentum, and that was a risk, and markets did pull back as a result of it. Now, the thing is that the markets still have one last hurdle, the recent high here around 326, 327 or so. Now, it looks like markets are going to open, but it's going to open below that level. So today, the question is whether markets can continue to push higher above that 326, 327 level. If it does, then we're going to bring it back towards around that 339 level. If it fails at this level, that's really where it's interesting, because then you could potentially see this roll over and potentially start testing 320s support here. So we do have a very narrow range that we're currently trading in. The question is, which way is the market's going to move? So today we want to take a look at some of the sectors and try to help answer that question as far as which way we think that breakout's going to happen. Now, one of the things that we always take a look at is technology. And one of the things I've been warning about is this massive negative divergence on the weekly chart for the Qs, which is the NASDAQ 100 index. And what we have here is a continuation higher over the past couple of months, whereas you can see as markets continue to move higher, momentum did not confirm those moves higher. So the Qs, the double top that got formed here at 270, still that major resistance level. Markets are about to open up a little higher, but still below that 270 level. So 270 is still key here for the Qs. We need to see a breakout above that, preferably with momentum confirming those moves, for us to believe that this rally has some legs here to the upside. As long as it stays below 270, we're still in this consolidation phase, especially with the high-flying sectors like technology and biotech, which is predominantly what the Qs or the NASDAQ 100 index is made of. Now, the one thing I still continue to point us to is emerging markets. Now, the emerging markets are becoming more and more of a theme now, especially as we're seeing dollar continuing to weaken. Generally speaking, weaker dollar is good for the emerging markets. It is generally not so good for domestic equities. So we may start to see some outperformance here in emerging markets and even other developed markets like Europe and Asia compared to the US equity markets. So right now, what we're still looking for is a breakout here above 44. It hasn't broken out yet, but that is the breakout level that we're paying attention to here on EEM as the daily money flow remains fairly positive here for emerging markets. But really the theme of weaker dollar has been dominating the equity markets here over the past few weeks. Many of you are invested or trading gold or silver, and we're seeing some of those moves in those particular names, but emerging markets is the other, I would say, sleeper that will be a net beneficiary of a weaker dollar. I did want to point us to small caps and equal weight as well, because small caps, it's starting to lag again. And this is the kind of yo-yo that we've seen over the past couple of months. Small caps leads, small cap lags, small cap leads, small cap lags. And it's kind of markets keep trading off between mega cap and small cap leading the way. Now, again, when you do have small caps at the very least keeping pace with the broader markets, that generally speaking is the indications of a relatively healthy market rally. And this is something we've been talking about for the past few months, but IWM has not managed to make it back above that last swing high, which is similar to the 323 high on SPY. We're looking for continuation higher here for IWM into that 152 range. Equal weight, same thing. Equal weight is lagging behind a bit now, just like IWM in terms of small caps. So we're seeing this across this theme across the board where we keep getting this yo-yo between these mega cap names and small cap and equal weight trading off between leading and lagging. And there isn't a strong winner here at the moment, but definitely something that we're continuing to pay attention to here for trading these markets. So as we said, over the past couple of weeks, we've been talking about this $96 level here on dollar index, breaking below that. We've got a pretty significant move to the downside here. We've got about a 3 standard deviation move to the downside here for the dollar. Now, is this going to continue? At the moment, if you look at rates, and that's one of the things we're going to look at here today, that certainly suggests that this weakness can continue. And that, generally speaking, is good for gold, it's good for silver, it's good for emerging markets, it's good for other currencies like the euro, yen. Those are some of the ones we're going to pay attention to here, some of the asset classes that maybe not everyone is paying attention to or trading, but definitely one that we're going to pay attention to here for ourselves. Now, one of the things that we normally take a look at is VIX. There's not a whole lot to look at here at VIX. VIX is very much in a very, I would say, complacent state at the moment. VIX 1 month trading at 24, VIX 3 month at 29. So the ratio there is a little more than 1.2, which is well in the risk on territory. You really want to see that ratio below 0 for us to get into a stressed condition where markets are likely going to sell off in a fairly quick and violent way. We're not seeing that at all. So despite the fact that we see this negative divergence, we're seeing this consolidation phase, we're not at the moment expecting a structural pullback. You might see a pullback of a few percentage points, 3 to 5%, but generally speaking, not more than that. So the put call ratio is something that we talked about here, because the put call ratio, the 20-week put call ratio is the lowest it's ever been since 2007. The daily put call, 20-day put call ratio is the lowest it's been since 2015. So there's a lot of complacency in the markets, and generally speaking, complacency means that markets can continue to move higher, but some of that complacency has started to bleed off a little bit over the past couple of days, but it hasn't moved much. So this is one of the things. So the put call ratio itself is at 0.71, but we look at the 20-day moving average because the put call ratio is a very noisy indicator. So we smooth it out using a 20-period moving average. Looks like it is starting to potentially reverse here. So some of that complacency coming back, meaning many retail investors potentially buying put options as markets reach this kind of consolidation phase. And I think there are plenty of potential short opportunities in specific equities, specific sectors even, and those are some of the things we're going to look at here today. So complacency, certainly something that is elevated risk here of that could contribute here to a short-term pullback. The 10-year rates yesterday started to break out again to the downside. Rates have pretty much held the 60 basis point level. This is the 10-year since pretty much the coronavirus sell-off, but yesterday, over the past couple of days, started to break down to the downside. This is contributing further to the dollar weakness. This is also going to move things like currencies. So as the US government bonds continue to decline across the whole curve and foreign currency interest rates remain relatively stable, or perhaps even some of them moving a little higher, that's going to cause a larger interest rate differential, and that's going to cause currency flows away from the dollar into other currencies. And that's going to further exacerbate this weakness that we're currently seeing in the dollar. So those are some of the opportunities that we're currently paying attention to right now. Now, you know, we look at a lot of charts here on our Tuesday and Friday morning market outlook sessions. I try to mix it up with some economic indicators that are useful for looking at the overall economy. I do think it's important for us to pay attention to economic indicators. But another thing that we kind of put to the wayside because it just hasn't really been a factor, but it's still, I think, important for us to keep in the back of our minds, is really looking at valuations. And this is more suitable for long-term investors looking at, you know, is the S&P 500 cheap or expensive? So this is Bank of America research, and they look at quite a few different valuation metrics, PE, there's quite a few different versions of PE, book value versus sales versus growth. There's all these different ones. And if you can see here, the average valuation for the most part is extremely high above its average. So anything in red means that it's above its average, and you can even see it in terms of how much it's above its average by standard deviations. As you can see, many of them are over 1, 2 standard deviations, some even closer to 3 standard deviations away from their long-term historical average. And as you can see, these are some pretty long-term historical averages. These are not historical averages over the recent periods. So if you can see, almost all valuation metrics here are in the red, with just a few exceptions. And arguably, there's only one that the market seemingly is paying attention to, which is the dividend yield of the S&P 500 compared to the dividend yield of the 10-year Treasury yield. And if we see Treasury yields continue to move lower while S&P dividend yields remain relatively stable, that continues to push this valuation metric into the green. So the average ratio of the S&P 500 dividend yield to the 10-year Treasury yield is actually 0.65, but it currently stands at 3, meaning the S&P 500 dividend yield is triple the 10-year yield. So if you're thinking about where money is going to flow, the Treasury markets is substantially larger than the US equity markets. And when the Treasury markets are yielding less than 60 basis points for a 10-year yield, and the S&P 500 is yielding 3 times that, that is naturally why you start to see further stretch valuations. And that's what stretches all of these other valuations to even more extreme, because investors that are seeking yield, that used to get it from fixed income markets, are not getting it there, and they're having to deploy their assets into riskier assets like the S&P 500 to get that type of yield. And this is part of what's causing this type of stress valuation. A lot of investors are currently asking, aren't valuations here too crazy? There's no doubt that the valuations right now are stretched, but arguably, the one valuation metric that really matters is really yield. And as you can see here, compared to treasuries, this is really where yield is actually extremely cheap. Nowhere have we had this type of outperformance of S&P or equity yield compared to fixed income. And if you think about the risk between TLT and SPY, TLT was extremely risky during the coronavirus sell-off. We usually don't see those types of moves during in the fixed income markets, but as you can see here, TLT was extremely volatile during the coronavirus sell-off, which means that you're not getting a lot of protection from these types of securities. So if you're looking at yield, and you typically use TLT and these types of securities for yield, and you're not getting that yield, so why, and equity markets are not significantly riskier than these types of fixed income products. That's part of why you can see this valuation in the equity markets continue to get stretched as long as this valuation metric continues to look more and more attractive. And it's actually getting more attractive here. So that is one of the concerns that we currently see in the market. And, this could be what causes, a bubble, if you will. But, the thing about this type of stuff is that these types of valuations can go on for months, even years, to continue get stretched and even more stretched before the bubble bursts. And what causes that bubble to burst is completely unknown. So it's a lot of times I hear from investors saying valuations are too stretched. I'm going to go short the markets. I think it's crazy that the valuations are trading like this. It's one thing to remember. It's one thing to know that the valuations are stretched. It's another thing to see the valuations reverse, and we're not seeing that yet. So it's important that we take stock of this stuff as we trade these equities to higher and higher valuations. Another thing I wanted to point us to are the Q2 earnings metrics. How have companies reported so far? You have about well over 60%, almost closer to 70% of the S&P 500 have reported earnings already. So far, the metrics look roughly in line with what we're expecting. Year over year, earnings is down about 42% from the same time last year. Sales down about 10% to the downside. So you've seen about 10% reduction in revenue, 40% reduction in earnings. Now, the one bright spot and that we're currently paying attention to is that 77% of companies in the S&P 500 that reported so far have beat on earnings, 73% beat on sales, 61% beat on both. On EPS and sales. Now, this metric normally is closer to about 40%, but as you can see right now, about 60% of companies have beat on both earnings and sales. So this is part of what I think is keeping this market afloat here at the moment, is this optimism. Granted that the bar was set extremely low here, so I don't necessarily think that this outperformance is that stellar, and I don't think this is in itself a reason to go long the markets. And I think the markets are reacting appropriately to this because we're not seeing big beats really move higher. With the exception of really Amazon and Apple, we haven't seen big moves to the upside. We have seen some spectacular misses and big moves to the downside. That, misses have been outperforming beats by a significant margin, almost 3 to 1 here. So markets, I would say, roughly just taking in this information, not moving a whole lot as a result of it. And again, this speaks to just the lack of information we've had this particular quarter, and the market just looking for information and trying to digest that information. And a lot of the consolidation, I would say, was due to markets waiting for this information. Now that we have more of this information, markets can digest and look at how to proceed going forward. But consolidation is, in my opinion, what we're likely going to see. But there are some specific sectors and sub-industries that are worth paying attention to. Last Friday, we talked about ITB, the housing index. And we talked about the housing index last week when it was just trading below this $50 resistance level, which is a major resistance level. And I wanted to update everyone because we now have the breakout. So housing continues to be strong. This is one of the sectors that I spoke, that Mike Coe brought up on CNBC last week. And I said that I think housing is one of the strongest sectors out there with the best outlook, if you will, for Q3 at the moment. And we have now a price breakout here. And this not only breaking out on an absolute level, breaking out on a relative level compared to the S&P 500. And you have roughly momentum at least confirming that move higher here. There is some negative divergence here on the weekly chart, so we want to be careful stepping into these. As I said, for those of you who joined me yesterday evening for the live market outlook session, my preference here for when you're playing these types of plays is to use call and call spreads. That is the best way to play these because call spreads allow you to take these views with the least amount of risk. Something like maybe a 52, 58 call spread here. As you can see on a $51 stock, I'm risking $2.35. So roughly about about 4% of the underlying ETF's value. That's all I'm risking, and I'm looking for further upside. But if this corrects lower, if markets turn lower, if we do get a bit of a pullback, a larger structural pullback, I'm only risking 4%. In this type of market environment, when you're pushing all-time highs and you think they're going to continue to push all-time highs as valuations continue to get stretched and you're concerned about pullbacks, and we're seeing negative divergences across the board on all of these markets that are moving higher, you have to use these types of strategies to protect yourself. This is really where options become your tool for managing risk, not anything else. The most important thing to do is to utilize options at this point to help you manage risk. So ITB breaking out to the upside. Communications, also one of the sectors breaking out to the upside, especially on this morning. It is just about to break out here above that 58.5 here. So pay attention to see if communications can break out above here, because it has managed to clear above its recent high of around 55 or so. It managed to break out above that $56 level, broke out, came back to retest this as support, and has been consolidating for quite some time and is now potentially going to break out here to the upside. So communications is one of the sectors that we're paying attention to very closely, because we do believe that this is a sector that is likely going to see a little bit further outperformance compared to technology and some of the other sectors. Consumer discretionary should be opening up today to a new all-time high with Amazon's print last night. Amazon pre-market is opening up around 3,200, so I do expect XLY to open up above that all-time high here. You do have fairly strong money flow on both the daily and weekly charts. You do have some negative divergence here on the weekly chart as well. Curious to see if today's push pushes momentum a little higher and maybe resolves some of that negative divergence here. On the daily chart, we also had negative divergence that hasn't quite been resolved yet. So this, if you get another move higher here in XLY and momentum doesn't confirm that move higher, that adds to further risk of a potential pullback here. So we do still see elevated risks of a pullback. And that's why my view here is that you might see some breakouts here on some sectors, but be careful chasing them. If you're going to chase them, use strategies that limit the amount of risk. There is the possibility that these markets continue to move higher, but I'm seeing a lot of negative divergence across the board. So I'm being more cautious here, chasing these longs, and doing so using strategies like the PayPal trade and the ConAgra Foods, where I'm buying call spreads rather than selling put spreads because of now the new elevated risk of a further pullback here. Technology also opening up XLK below the 110 level, so pay attention to here. I'm not sure that we're going to get that breakout here. We do see that's this negative divergence as the markets continue to move higher. Momentum is not confirming that. You have the negative divergence here on the weekly chart, so be careful chasing these to higher. And I think that perhaps you might see a temporary top here around 110 on XLK. XLE breaking down, so energy breaking down. We saw ConocoPhillips yesterday break down to the downside. We're seeing a lot of energy names continuing to break down to the downside. So XLE looking like it's going to start getting a bit of a push here to the downside. This is one of the few sectors that we're currently bearish on here and continue to be bearish here on XLE. Real estate is looking a little interesting because recently it's consolidated for quite some time and is now starting to break to the upside. Real estate, much higher yield than the S&P 500 at about 3.2%. So this is part of the reason why, as you get more consolidation and more of a defensive tone, why you might see XLRE, XLU, XLP start to outperform. And you have this $36 level that it's starting to break out above. It's also potentially breaking out above the 200-day moving average. So you have a lot of confluences working together that could see some flow into XLRE. Delta Airlines, I wanted to take a look at the airlines. You know, I had a short Boeing trade on CNBC last week, and that trade worked out well. We sent out an email last night to take profits and sent you this morning to take profits on that. I'm looking to take profits on that this morning. But I actually now think that the move to the downside here for the airlines and aerospace is just starting. If you look at Boeing, it's just breaking down to the downside. So I actually think there could be further downside here for Boeing. Boeing just breaking below that at support level here on Boeing, and I think that you could get a continuation lower. So I'm using the airlines to play this, using Delta Airlines. Delta Airlines also breaking below this major support level and looking for a potential continuation lower here. You know, if you look at the stats from airlines, they just don't look particularly strong, especially going into the end of 2020 and the outlook they have currently for 2021 and further out. I think that there could be more pain ahead, especially for the legacy carriers that have focused very much on the more premium corporate flyer rather than leisure. Those are the airlines that are likely going to hurt the most, and Delta falls into that category. And lastly, I want to show you an example that is a little unconventional, that may not be on everyone's radar, but is another way to continue to play this dollar weakness, which is through the currency market. So as we see the US 10-year yields, the 2-year yields start breaking down to further all-time lows, and we see that other currencies like the Japanese yen, the euro, the Canadian dollar actually yield roughly double what the treasuries are yielding. You have this currency carry that is going to shift the strength away from the dollar into these foreign currencies. So Japanese yen breaking out to the upside here. So as you can see above this 89.5, 90 level, which has been a long-term resistance for this particular currency, and is starting to break out here to the upside. So I think you could potentially see further gains to the upside here for the dollar yen. And FXY is an ETF that you can trade on that move. Currencies have very low implied volatility. They have very low volatility, which is why call options on this are very cheap. But just keep in mind that currencies don't move as much. So you might think that they're really cheap, but just keep in mind that the underlying volatility of currencies are roughly a half to a third of the equity market. So options naturally are also going to be cheaper. So those are some of the ideas that we want to share with you here today, and what we're currently watching and why we think a consolidation is more likely to be our base case here at the moment, unless things really start to break out to the upside. But even those breakouts to the upside, we see further negative divergence that we think is going to be a concern for the markets. So with that, I want to thank everyone for taking the time out here this Friday morning. Before I let you guys go and open this up for Q&A, I do want to send everyone a survey because we're trying to continue to improve our OptionsPlay service. I just sent a link into the chat window. If you don't mind, take a few minutes after we finish here today. It'll take just a few minutes for you to answer a quick survey regarding our services. We want to understand what you guys are utilizing, what you guys want more of, giving us some feedback so that we can continue to improve our services. So with that, I want to thank our current members and our paying subscribers for supporting us and allowing us to continue to do this. If you haven't subscribed yet to become a member, you can do so by clicking on the link here on your screen by trade.optionsplay.com/member, which I will post into the chat window as well. So both the link to the survey and the link to become a member are both in the chat window. And it looks like we have a couple of minutes here to try to answer some questions. I know there were a few questions here while I was talking, so I'll try to answer that. Kel is asking exit eBay trade. So I haven't issued an exit for the eBay trade yet. I'd like to get a little bit more premium out of that before we close that out. Patrick is saying, if I'm not in gold, how would you recommend entering, selling put verticals or buying calls? So, you know, gold, the reason that I haven't talked about gold here today, because I do think it's gone a little too far, too fast. It's consolidating a little bit. You know, selling put spreads, I do think is you can do it if you're comfortable with the risk. I prefer more buying calls and call spreads rather than selling puts at this point because of the higher elevated risk of a pullback here. You have a very severely overbought condition on both the daily and weekly charts, and you have this negative divergence here on the weekly charts. So I'm concerned about selling puts here. I'd rather be buying calls, take on less risk. What's the green chart that you present? Is a volume? No, this green chart is Chaikin money flow. This is a pretty standard indicator on most charting packages, money flow or Chaikin money flow. Are we looking at the right graph? We're generally looking at this. So the graphs are always a weekly chart and a daily chart. So I get a zoomed out view and a zoomed in view. So we're generally looking at both. Which momentum study are you using on my charting? I'm using a 14-period I'm using a 14-period RSI, so a very standard momentum indicator, and I've added a 9-period moving average to my RSI because that helps me smooth out the choppiness of the RSI indicator. Please explain percentage with EPS beats. This is just percentage of companies that have beat the earnings estimate. So, you know, when you hear about earnings per share, So when you look at Apple, Apple was estimated to have about $2.05 in earnings, but the actual earnings was $2.55. That's a beat on earnings per share. How can we create money flow in our charts? So Mike, most charting packages have Chaikin money flow or money flow indicator. When you say you prefer call spreads, do you mean that in bullish assets? Yes, correct. If it's a bullish asset, I prefer buying long calls. If it's a bearish asset, that depends, you know, right now, depending on which bearish asset. For Delta and for Boeing, you know, could I buy a put spread? Certainly. I could also sell a call spread here for puts. American Airlines actually holding up substantially stronger than Delta. Looking a little stronger than Delta. I do think that American, which you know, is out of the three legacy carriers, focuses on the corporate travel the least out of the three. I mean, certainly more than Spirit and all the other discount airlines, but American Airlines holding up a little better than Delta because Delta does sell more premium seats than American Airlines. And I think that is one to pay attention to. Okay, that covers what I wanted to share with you guys here this morning. I hope you guys have a great Friday. I hope this was helpful in helping you set up your views here on the broader markets and individual setups. With that, I'll see you guys on CNBC later tonight. Have a great day.